Well, it's a pleasure to be here today. Of course, at my age, it's a pleasure to be anywhere. You'll notice the title here of this presentation. I have chosen to take the route of the government and basically shut down for a while. Now, one of the great things about America, only in America can I get a fee from a bank when the answer to their questions is, I don't know. And I still get a fee for it. It's kind of a great gig to have in this environment. We're dealing with a myriad of issues that create what I think is a period of the greatest uncertainty about what the next year, 18 months, is going to be like, with a wide range of possibilities about where we end up in terms of economic growth, job growth, inflation, interest rates, the stock market, you name it, and there's a huge amount of uncertainty and unknowns that, frankly, we're going to have difficulty determining until we get the government back open and actually start to get some data. And that's going to be the challenge that we're going to have to go through. But I want to remind us what the U.S. economy is. When we talk about, and I've gone through this before, we talk about real gross domestic product, real GDP. Real GDP is the sum, dollar sum, of three specific spending categories. First of all, personal consumption expenditures, which is what we all spend each month, each day. Secondly is business fixed investment. That's what companies spend on equipment, their facilities, capacity, and so on. And finally, government spending. Now, they adjust the dollar amount of that spending for each time period but with inflation. So what they do is they remove the spending levels that reflect increasing prices and try to get down to a measurement of the unit volume that the economy is producing. And that's the measure of the size of the U.S. economy. Now, that gives us a total number. To that total number, they then add or subtract inventories. If the economy produces more product than is sold and companies' inventories rise, that's not really economic activity. It adds to it when inventories go up, but it subtracts from the economy when inventories decline. This is an important number here in the last 6 months or so. And then finally, we subtract what is the trade deficit. How much goods are produced outside the U.S.? What do we import? Because that's not an economic activity in the United States when we buy foreign imported goods, all of which are adjusted for price to get to real GDP. Now, the important point here, I think, in doing this is to remember that nearly 70%, 69.1% of the total is personal consumption expenditures. So whether the economy grows or not in any given time frame is highly dependent on consumers. Do consumers increase spending, decrease spending, or keep it about the same? That's going to be the largest single factor creating either positive real GDP growth or a recession. You end up with a recession when consumers pull back on their spending primarily. Government spending and business spending, relatively smaller amounts, 16, 17, 18% around that category, or a total of about 30% of the economy is those spending categories. So we're highly dependent on the consumer and the willingness of the consumer to continue to grow spending, increasing final demand. If we look at real GDP in the last 2.5 years, we can see that, and I trendlined this, the red line's a trend line, the U.S. economy has been slowing in its rate of growth over the last 30 months. You can see that there's a slight negative slope to the trend line over that time frame with a tremendous amount of volatility. For example, and then get into the weeds, but I got to, with no data to review, I got to spend time in the weeds today just to fill up my hour, which is how I get the fee I get. Sorry to tell you that. But if you'll notice, in the first quarter of 2025, the real GDP declined by 0.6%. We actually saw a negative real GDP number, okay? But in the second quarter, it grew by a whopping 3.8%. So we had a huge amount of volatility in the first half of the year. Does that mean that the consumer stopped spending in the first quarter of this year and then spent it all in the second quarter? No. What happened, of course, in fact, personal consumption expenditures, that 70% of the economy is the red bar. You can see that in the second quarter, or the first quarter of this year, PCE, personal consumption expenditures, actually increased. A small amount, but it increased. What happened in the first quarter? Huge increase in the trade deficit. We went from a little over $1 trillion trade deficit in the fourth quarter to $1.4 trillion deficit in the first quarter. Anybody want to know why the trade deficit ballooned and skyrocketed? Exactly correct. What companies did with the announcement of all the tariffs after the election, as uneven as those announcements were, as uneven as was the execution of tariffs, as all of the news about tariffs, what it did is it caused companies to say they're going to impose tariffs of some kind, prices are going to go up when they do that, I better buy now before the tariffs take effect and put it in inventory. So they pre-bought in anticipation of significant increases in prices due to the tariffs. Well, in the second quarter, the reverse happened. The trade deficit plummeted from under $1.4 trillion to about $950 billion for the quarter. So we saw a huge benefit to real GDP in the second quarter with the reduction of the trade deficit. So it created this volatility, whereas in reality, consumer spending remained relatively solid throughout the whole period. In fact, if you look at it, you can see that consumer spending has been above total economic growth in, 6 of the last 7 quarters, 5 of the last 6 quarters, okay? So the consumer, in spite of all of the uncertainty out there, has continued to increase spending. Final demand has increased at a steady pace. As long as that's happening, it's difficult, very difficult, to end up with a recession. In fact, it's almost impossible. Now, that's where we are today. The question is, where do we go from here? What's going to happen here? We have no data. So, for example, we got no retail sales data for September. Wasn't issued. Don't know what retail sales did in September. We got no personal consumption expenditure data for September. Hasn't been issued, won't be issued because of the government shutdown. They're not collecting the data. They're not essential workers. So we have to look to anecdotal evidence to try to figure out what's going on in the economy in the face of all of these other uncertainties and without the data. The Federal Reserve is meeting this morning, today. Tomorrow at 2 o'clock, they'll announce any rate decision, change in interest rates that they may decide to do. They have no data. So they're shooting in the dark as to what they should be doing from a monetary policy standpoint. So we have to go and look at the anecdotal evidence that we do get, one of which is consumer confidence surveys. This happens to be the Conference Board's Consumer Confidence Survey. It's the longest one in existence. They've been doing it for 40 or 50 years, which is why I like to use it. And you can see that there is a pretty close correlation between Consumer Confidence Survey, the Conference Board survey, and recessions. The shaded bars are the two recessions we've had, the Great Recession back in 2008 and 9, the real estate recession, and then the pandemic recession in 2020. In both of those cases, you can see consumer confidence just plummeted. The problem is, it didn't plummet until the recession started. So there was no predictive, the correlation of any kind of a predictive element of consumer confidence surveys hasn't been very good. The consumer tends to react after the fact as opposed to giving signals leading into any potential recession. Now, here's where we are today. The same thing, the consumer confidence survey, a little closer. And it was actually released this morning for October. It came in at 94.2. So it came in about where it was in September. If this was had any kind of predictive qualities to it, you'd conclude that the economy is continuing to expand and there's no indication that the consumer is beginning to pull back and slow spending growth. However, we know that predictive quality of this survey is not all that good, but it's the only data we've got. We can look at some things like, what's the condition of the labor market? Don't know. The BLS, the Bureau of Labor Statistics, didn't issue an unemployment report or job growth report for the month of September. They won't issue one for October, which would be due a week from this Friday for October. They won't issue any of that data until the government reopens. Now, they did open one part of the government, and that was they brought back, it's the Bureau of Labor Statistics that calculates the consumer price index and the producer price index, but they brought them back and determined they were essential workers, that they had to have a inflation number for the month of September. The reason is because Social Security has to determine the cost of living adjustment that they're mandated by law to execute for 2026. The cost of living adjustment's based on the consumer price index. So they had to get the consumer price index out and computed in order to do the cost of living adjustment for Social Security. We know that the data that came in last week for the month of September, the base month for that calculation, came in at about 0.3% for the headline number and 0.2% for the core rate of the CPI. Those were less than expected, but the net result was the year-over-year number for both the core and headline number still came in at a little above 3%. So inflation through September running about 3%. The net of that is, for any of you on receiving Social Security payments, is a 2.8% increase in your Social Security payments beginning in January, based on the inflation rate of about 3.1% year over year through September. And that's the only reason they brought those people back to do that calculation. Everything else has been shut down. So we don't have durable goods orders. We don't have a lot of data that we have to have in order for the Fed and ultimately all of you to determine what does it look like the economy is doing right now and what's the likelihood of the direction it's going in. Consumer confidence has held up. It's down from its peak of 112 back in December of 2024. The peak on this index was back in 2019, just before the pandemic, and it was about 139 was the peak in the index. So it is lower, but it is still, as I said, the predictive value is very good. Now the Conference Board also issues, this survey is a reflection of the current conditions of the respondents in the survey. They also do, what are your expectations? They do a survey of what the consumer's expectations are. The that's easy for you to say, it's not very easy for me to say. Expectation component is down around 61 reading. Anything below 70 historically has been a fairly good indicator that we're about to enter a period of very slow growth in consumer spending. So we're getting some mixed signals from this anecdotal evidence. We'll get some data that isn't government originated. We'll get auto sales, for example, for the month of October. That'll be released next week. We get some home sales numbers that are issued by non-governmental agencies, building permits, housing starts, those kinds of things. So we'll get some housing data. But other than that, we're not going to see any data. And the issue is going to be, when the government does open up, we're going to have a bunch of noise, because they're not going to go back and try to figure out what September's numbers were. If they opened up the government today, they're not going to go back and try to figure out September's numbers. So we're going to go from August to what will probably be November numbers for any data that we released. A lot of things can happen over a 2 or 3 month time frame, all of which will get thrown into one data release when in fact they start to release the data. I have no idea when that's going to happen. When is the government going to reopen? Nobody knows. Clearly they vote every day, and every day the vote is the same. So there's no indication that there's been any breakthrough in the negotiations on opening the government to get things like the data. Now, there's going to be a huge amount of pressure right now. Most of the people who were working, government employees, who were working after October 1st, who worked through into October, did get paid their paycheck the middle of October. They are not going to get a paycheck at the end of October. That includes air traffic controllers. For anybody who's got an airline ticket to fly to Florida, you might want to drive. I'm not sure I want to be in an airplane when I got a bunch of dissonant air traffic controllers working extra hours and not getting paid for it. Their attention span may not be as acute as it needs to be. But we're going to end up with a real problem here, because the initial pay to those government employees is going to not going to be here at the end of the month, their second payroll. So I think that adds a lot of political pressure on people meaning Democrats, to come back and say, we've got to get the government open. That's a feeling of mine. Do I have any way of looking at that and saying it's going to happen? Absolutely not. It's a pure guess. Okay. So the issue is, where do we go? The issue that we're dealing with today is monetary versus fiscal policy. These are the two sectors of government that make the decisions that have the biggest impact on economic growth in this country. We know, for example, without the government being open, that fiscal policy is restrictive. In other words, what the government has done with fiscal policy results in downward pressure on economic growth. Tariffs being the best example of that. Okay, that obviously creates fewer jobs in this country initially, and higher prices. Inflation goes up with the tariffs. The one big beautiful tax bill will eventually be fiscal stimulus, but it's going to take until next year until most of us realize the benefits of that tax bill. We know that when you shut the government down, you reduce the number of employees, the people getting paid. That's a significant depressant on economic activity. 780,000 government employees aren't getting paid. They're not spending money, and that will be a negative on economic growth in this country. So fiscal policy in the short run, meaning through the first half of next year, is restrictive. At the same time, the Fed, which conducts the monetary policy, is attempting to be stimulative. The Fed has a great deal of concern about where the economy is and where it's going. So they are taking steps today to try to stimulate the economy by, first of all, lowering interest rates. They cut rates in September. We expect another 25 basis point cut tomorrow afternoon, and we're going to see in a minute what the expectations are longer term for monetary policy, which continues to be to stimulate the economy. The Fed has a dual mandate from Congress by law. This is what they're supposed to do. First of all, they are to conduct monetary policy in such a way as to maintain full employment. Now, define full employment. For several decades, people said if the unemployment rate was 5% or less, that was full employment. There'd always be 5% of the workforce that was in transit, that quit a job, stopped working, was moving from one job to another, maybe even moving where they lived to take another job. But about 5% of the workforce wasn't working actively, but the rest, the 95%, was, and that would represent full employment. Certainly with an unemployment rate right now, well, the unemployment rate in August, the last time we had the number, was 4.3%. So one would conclude that the Fed has met its first mandate, which is to conduct monetary policy in such a way as to promote full employment. The Fed has a real fear about whether that's going to last or not, and we'll look at that in a minute. Their second mandate is to maintain price stability. They are to conduct monetary policy in such a way as to make sure inflation does not accelerate, doesn't get out of control. The Fed has said that an acceptable level of inflation is 2%. If 2% price increases occur, that's actually reflective of a healthy economic environment. It happens because demand is rising faster than the supply of goods and services, and prices are going to go up at a modest pace, but they're going to rise. And that's a healthy environment. As a result of the CPI number coming out last week that would have been for September, we know that CPI, at least, Consumer Price Index, is running at 3%. So it's running a full percentage point above what the Fed says is an acceptable level of inflation. So certainly the Fed would conclude, and I think most of us would, that they have not met this mandate. And therefore, they need to be aware of that fact and adjust their policy decisions in order to bring inflation down. How do you do that? You don't stimulate the economy by lowering interest rates. If you want to bring inflation down, you raise interest rates and you tighten liquidity in the system. The Fed was doing that. They were tightening liquidity. Not many of you probably even ever heard of quantitative tightening, but the Fed for the last 7 months has been executing quantitative tightening, which is, now I'm really in the weeds. As a result of the pandemic and the shutdown, the Fed expanded their balance sheet from about $4 trillion to $9 trillion. So they added $5 trillion of liquidity into the U.S. economy. That liquidity was used by a lot of people to increase spending, hire people, pay increases, and so on. That was stimulus, okay? At the same time, the Fed they raised interest rates during that time. We got up to a very high Fed funds rate until a year ago at this time. A year ago, they dropped interest rates 100 basis points in the last 3.5 months of 2024, and then held them steady until the September meeting this year, when they dropped 25 basis points, and they're expected to drop another 25 basis points tomorrow. So at the same time, the quantitative tightening was, as the bonds that they bought to add this $5 trillion to their balance sheet begin to mature, because a lot of those bonds were mortgage-backed securities, which have principal pay downs every month, so the balances decline every month. And there were the treasuries they bought also had maturities. They were not replacing them, so they were not going out and buying bonds to replace the cash flow out of their balance sheet. That was removing liquidity from the system. So that was, in essence, a restrictive monetary policy position. So we had the Fed kind of doing both at the same time, dropping interest rates, but removing liquidity. Now, if you're still awake, you're way ahead of most people at this point in the presentation, because I've gotten way deep into the weeds, and I didn't mean to. But I wanted you to understand that we've got the conflict between the desire to maintain full employment and to maintain price stability, okay? And that's kind of where we are. Here's the inflation number I talked about, 3% on just released in September. The Fed's primary measure of inflation is something called the PCE price index, which is the red line. That number is not being released because that's not, and the Fed likes to use that because it's a much broader measure of inflation. For example, in the consumer price index, 32% of the index is housing. Well, not everybody buys and sells a house every month, and not everybody gets an increase in their rents or lease payments if that's what they're doing. They probably have to wait till the lease runs out or the contract runs out. So the Fed says because that number is calculated as if you did sell your house every month and bought another one, or if your rents went up every month, or leases went up every month, that's what the inflation rate would be. The PCE index, it's only about 11% of the PCE index. So they like to use the PCE index as a better measure of where inflation is. And that's why it runs slightly below, not slightly, but well below where the consumer price index is. So the Fed would conclude that inflation had reached a low point of 2.2% in April of this year, almost to the 2% target rate they've set, but not quite there, and then have moved up as the impact of tariffs are beginning to be felt on pricing in this country, okay? The unemployment rate has held very steady through all of this. The unemployment rate is 4.3% with the last reading that we have. It's been between 4.1 and 4.3 for the last 15 months. So unemployment has not risen meaningfully and is well below what most people would consider full employment to be. So why is the Fed worried about the labor market? Why would they lower interest rates in the face of their inflation numbers above their target and being what most people would consider full employment? The reason is job growth has slowed dramatically. This is non-farm payrolls by month over the last year and a half. And as you can see, a dramatic slowdown in job growth has occurred in the last 4 months. I mean, we went from averaging 175 to 200,000 job growth a month in 2024 to 38,000 average in the last 5 months. So the Fed looks at this and says, oh my goodness, we're about to see unemployment skyrocket because job growth hasn't gone up. Now, with that is, we haven't seen this translated into a rise in first-time claims of unemployment. Each state collects that data and then feeds it into the government to release a national number. That number has stayed pretty consistently between 225,000 and 250,000 a week for the last probably 4 or 5 years, which are first-time claims for unemployment insurance. If that number were to jump to 400,000 and stay at that level, that's when unemployment rates would begin to go up. So what's happened in the economy? Business people have stopped hiring. They're not filling positions. They haven't laid people off. They haven't gotten rid of people. because the cost of replacing them when the economy turns around and expands at a faster pace, they've learned their lesson. I can't find people that I need in a lot of jobs. So they're willing to keep people on the payroll and keep them working, not lay them off, but I'm not going to fill open positions either. Okay? So we've got a situation where job growth has slowed, but the unemployment rate has not risen dramatically. Now, could that change? Yes. When will we know that it's changed? When they release data that tells us it's changed. So we don't know that that's happened. You all probably have a better feel for what's going on in your business environment, the segment that you're in, than I do as an economist trying to look at numbers, trying to figure out what is the condition of the labor market. The best we can say is it appears the labor market is okay. It's not in the dumps. We're not looking at an environment where unemployment has skyrocketed and we're headed for a recession. The labor market doesn't tell us that. So the Fed's conclusion was, of the two mandates, if we're going to have to give up on one, if I can only get one accomplished at a time, I'm much more willing to allow a higher rate of inflation than I'd like to avoid seeing a rise in the unemployment rate. So they're willing to continue to be stimulative to avoid what they see as a real risk to the economy in the labor market. As a result of the Fed's monetary policy changes, you can see what's happened to interest rates. These are the Treasury yield curve. The red line is as of year-end 2024. The yellow line is where those rates were yesterday. They closed out last night. Let me point out a couple of things. The 2-year Treasury is historically always the most sensitive to Fed monetary policy changes. That rate has dropped by 75 basis points so far this year. Went from a 4.25 rate at the beginning of the year down to 3.48 as of last night. If that rate continues to decline, then that's further indication that at least investors believe the Fed's going to continue to cut interest rates and we're going to continue to see lower interest rates. What we've got here, obviously, is what's called a steeper yield curve. The spread between the 2-year Treasury and the 10-year Treasury has widened because the 10-year rate has only dropped about 60 basis points in the last, since the beginning of the year. So you got 75 basis points down on the 2-year, 60 basis points down on the 10-year. The 10-year is a critical number. The 10-year is the single biggest factor in determining mortgage rates. So if the 10-year stays up around 4%, then you're going to see 30-year fixed rate mortgages continue to be 6.25% to 6.5%, which is where it is right now. In order to get a significant increase in home purchases and housing activity, I think you've got to see the mortgage rate below 6. It's got to be in the 5s. So the Fed has to drop rates in order to get these longer term rates to come down. In order for them to do that, inflation needs to be held in current levels and hopefully even decline somewhat. Again, we won't know until they give us data. So we have any idea as to whether inflation has plateaued and may come back down. You have to have an opinion about that. Hard to have an opinion without other data indicating where the economy's headed. Okay, here are the uncertainties for next year that make it difficult to do any forecast. And I promise you I'm going to do a forecast. First of all, the government shutdown throws everything in the whack. Lack of data, it has an impact on the economy. 750 or 800,000 people not getting a paycheck affects consumer spending. It affects consumer final demand. It affects data. It affects an understanding of what's going on. All of the problems that we have with the government shutdown. So that creates a huge uncertainty. The problem is going to be, as I said, once they open up, we're going to get a bunch of noise with data. we won't get real data that we can use to make reasonable decisions about what's happening in the economy overall until, I mean, if they opened the government up tomorrow, we won't have data that we can use reliably until January or February, because we're going to get 2 months of catch-up data. A whole bunch of noise is going to come through this. So the government shutdown is certainly created risks that data, when it does settle out and we get a fair representation of what's going on, it's going to be January or February. Secondly, tariffs. We all saw Ronald Reagan's opinion about tariffs. I think you all saw that. He didn't like them, certainly. Ontario doesn't like them. Canada didn't like them. A lot of people don't like tariffs. The reality is that the fear is that tariffs were going to drive inflation up. Hasn't happened. We did not see significant increases in inflation. Yes, it went from 2.2% in April up to 3% in September, but it didn't skyrocket. We're not talking about 5, 6, 7% inflation as yet. The reality is those tariffs are not being fully passed on with price increases. Companies are eating some of that cost increased. They're taking lower margins. They're unwilling to give up market share by raising prices as much as their costs may be increasing, and they're finding ways to reduce costs in other areas so that they can control the magnitude of increase that we get in inflation due to tariffs. So tariffs, and the last point, the execution of tariffs has been abysmal. I mean, nobody can count on a tariff lasting for any length of time. It's going to get negotiated away or changed. We're in the middle now of coming to some agreement with China on tariffs process because China quit buying soybeans from the U.S. So you end up with a reduction in tariffs on imported goods from China so that China will reopen and start to purchase soybeans from the U.S. because soybean farmers were under tremendous pressure with prices down. So you get a lot of political noise with tariffs, which is always the problem. One of the issues that I always have fun with, and I do this a lot of times with college students or even high school students, is I ask them to define socialism. What is socialism? Does anybody want to know? Does anybody want to take a whack at that? What is the definition of socialism? Nobody knows? Nobody in this group knows what socialism? That's the biggest debate we have right now politically in this country. Are we going to head toward a socialist direction, or are we going to not head in the socialist direction? And the reality is, most people can't define it. They don't know what it is. They just know one thing. One group of people says socialism's bad. The other group of people say socialism is good. But when they can't define it. Well, the reality is socialism is an economic concept, not a political one. It's not a political theory, it's an economic theory. And the theory is that a central planning, central government control of the means of production is socialism, where the central government defines what's going to be produced and how much of it's going to be produced. That is socialism. It is controlling the resources any society has. Capitalism, on the other hand, is the market makes that decision. It's supply and demand that defines how much of any goods or products are produced. The market makes the decision versus the government. Well, the issue with socialism always is, once you say to the government, you have the authority to tell us how many cars we can produce. You have the authority to tell us how many PlayStation units you can produce and put in this country. Once you do that, you bring in all of the social issues. For example, if the government says you can only produce 3.8 million PlayStations, and it's because we're going to limit it because we think it's bad for kids to spend all that time playing games on a computer. Okay? So they're attempting to reach a social objective with a economic dictate. Once you enter the social objectives and the political decisions, that's when socialism falls apart. Because you end up with uneven and unproductive economy. People don't understand that. They don't understand that politics becomes a much bigger element of the economic process in a socialist environment versus a capitalist environment. Now, I'm not saying capitalism is great. There's certainly excesses that come from capitalism. That's how you end up with child labor laws and a bunch of other things. Greedy business people, you want to pay 13-year-olds to work in a sweatshop at 50 cents an hour, which is what happens in unfettered capitalism. But the reality is we have to make that decision in this country, where we're headed now. The most obvious example is New York City. I mean, they're going to make a decision about the mayor of New York City, which is a clear choice between socialism, at least, if not, and by the way, what's communism? Is communism, socialism the same thing? No. Communism is an economic concept where the state owns everything. They own all the resources, raw materials, factories, they own everything. So they are making all the decisions about who works where, how much you get paid, all of that. So socialism is even further left than, or communism is further left than socialism. But New York City is apparently running somebody who's close to being a communist, not the political concept of communism, but the economic one. And they're going to make that decision. Speculation is if he's elected and starts to implement some of the recommendations, you'll see massive flight out of New York, that people will be moving to Florida or anywhere, maybe even Northwest Ohio, but somewhere other than putting up with what it'll cost to be in New York City to pay those taxes. Boy, but I get off on a tangent and I was really talking about tariffs. It's the uncertainty that this all creates, okay? Labor market, does unemployment rise? Do we see companies start to lay people off? I saw this morning, Amazon announced 14,000 reduction in salaried personnel at Amazon. I'm not talking about the hourly people driving the trucks or working in the warehouse. I'm talking about their salaried management levels. They're going to reduce it by 14,000 people. I'll talk about the reason they cited for that in just a minute. Okay? So the fear is that we're in the early stages of a significant increase in unemployment as companies react to the environment we're dealing with. What's inflation going to do with tariffs? Will ultimately companies say, no more, I can't absorb these costs, I got to raise my prices to cover those costs, or I'm losing money every day. So far they haven't done that, but could inflation spike as a result of tariffs, and heaven forbid we actually have strong final demand growth without the production increases that are necessary? Could. Federal debt continues to be a problem. We're at $37 trillion and counting in terms of the size of our federal debt. We spend more in the interest payments on our federal debt than we spend on defense spending. Just the interest payments. It's well over $1 trillion a year in interest costs. One of the reasons that people want the Fed to lower rates is to reduce the interest cost on our federal debt so that we don't have to pay that interest every month. But the reality is the federal debt is a huge drag on our economy and will continue to be so as long as it stays up at these levels. All of these things create a real issue in confidence. And will confidence remain high enough that we can avoid a recession, that we can avoid a downturn? And if it is a downturn, can it be very severe? Okay? This is all added to the political instability that we have. The reality is, this country has yet to make the decision about whether the role of the federal government is to ensure that everybody has equal pay, equal incomes on one end of the spectrum, and the other end of the spectrum, that everybody has equal opportunities to be successful. We haven't made that decision. There are a lot of people in this country who believe the government should be in the business of dictating equal outcomes for everybody. And there are a lot of people in this country who believe that people ought to have the ability to succeed based on the hard work or the situation they find themselves in. We haven't made the decision which one of those directions we're going to go as a country politically. And until we do, it's going to be very difficult to get rid of the political instability. Some people would say the election last fall was the start of heading to the right of center between the two ends of the spectrum. But obviously, those on the left of center are not happy with that decision. And so we end up with this political instability. That does not create confidence in us, in what's going on here, and it certainly doesn't create confidence by those outside the U.S. Just look at what the U.S. dollar has done against foreign currencies. A lot of that's a reflection of this political instability, but that's a huge uncertainty. And here's the big kicker: AI. AI, I believe, we are at the early stages of what will be close to what was the Industrial Revolution in the late 1800s and early 1900s. We're looking at massive changes in the way we do business as a result of AI, what it will do. The reason Amazon said they're eliminating 14,000 salaried personnel was because they're instituting AI solutions to do the jobs that those 14,000 people were doing. Amazon is developing now the robotics run by AI to staff their warehouses. I don't need people pulling product off a shelf, putting it on a conveyor belt. I can get a robot that can do that. And it'll be run by AI. Those are just the examples of specific examples. As companies come back to the United States, and that's the benefit of tariffs, is it forces companies to come back. Why did they announce the huge investments in the United States in new manufacturing facilities that they did, including here in Toledo, but also in other markets? They did so because they knew they had to avoid tariffs by producing product in the U.S. It kept their costs down. In increasing production of product in the U.S. to avoid the higher cost of tariffs. Well, that makes a lot of sense, but the problem is the plants they're going to build aren't going to be requiring the same number of workers as the traditional factories did in the past, where there were assembly lines with people putting parts together. Robots are going to be doing a lot of that. AI is just starting, and it's going to continue to be massive. Banks are a good example. I don't need all those people in the back office at the bank, a bunch of people with green eye shades and sitting there punching calculators to figure out what the bank's interest was or what you owed on your loan. I've got computers that are going to be doing all that work, and we're going to automate that. So the requirements that companies will have for employees and the nature of those are changing dramatically, even in the service industries. And that's, to a large extent, what Amazon is a service industry. And they're going to automate. So AI, we're just at the beginnings of that, huge impact. What does that mean? Does that mean that we don't need immigrants? We don't need foreign workers in this country because we're going to have excess labor as this transition unfolds? Or does it mean we're going to need more? Because there are some jobs that we can't automate, like picking grapes, although some of that can be automated, has been. And therefore I don't need the migrant workers to come in and do that work. We're at the very early stages of a transition in the U.S. economy. One of the biggest problems we have in this country is housing. And the problem is it costs so much to build a house. AI is going to address that issue. We're going to see abilities to build a house at significantly lower costs because of AI. And you can see technologies starting to be developed. I mean, you can do a printer now and build a house. Doesn't look very good sometimes, but at least initially it'll build. You can build it without the people. AI is huge. If you're not investigating how to use AI in your business, you've got to start. It's going to be huge, okay? There is something called the Fed Funds Futures Market in terms of the interest rate expectations. This is the probability of the Fed cutting rates, and this happens to be at the December meeting. There's a 93%, 91%. Thank you. Somebody's in better shape than I am. And you're a lot further away too, okay? There's a 93.4% probability the Fed's going to lower interest rates 50 basis points by the end of the year. 25 basis points tomorrow, 25 basis points in December the 10th, their next FOMC meeting, okay? So the market is saying the Fed's going to continue to lower interest rates. I went out and looked at the probabilities for next July, and it's over 50% probability, almost 60% probability, that the Fed's going to cut rates by 100 basis points in total between now and next July. So we get another 50 basis points at least, according to the probabilities out there. So the market's saying the Fed is going to continue to be stimulative. Monetary policy is going to offset the initial restrictive policies resulting from tariffs and the fiscal policy that plans that are currently being executed, and it'll be the second half of next year before we know which of those were the right decisions to make. Okay, I said I'd do a forecast. This is worth exactly what you paid for. This is the forecast I had before the government shutdown, and I'll stick with it. I think we're going to see something. We're not going to see a recession in 2026. I think the economy is strong enough. We'll see a slowdown to about 1% growth in the fourth quarter of this year. When we get a number, I think it's 2.5% growth in the third quarter. And then we're going to average a little over 2.1, 2.2% real GDP growth in 2026. That's in spite of all the uncertainties I just went through. I think the consumer is in good financial shape, even though we see delinquencies in credit card payments and car loans starting to rise. But I think the liquidity is going to be more than sufficient in 2026, pumped by the Fed, that we will avoid a recession. The question is, what's 2027, 28 going to look like coming out of this period of uncertainty? If you believe these uncertainties are going to be resolved, then you can, I think, be optimistic. If you think these uncertainties are going to continue to plague us well beyond 2026, then the likelihood of a recession increases dramatically. I don't know which way it's going to go. And this is where I get to the point where I'm just thankful to get paid a fee for saying, I don't know, which is where I am, okay? So I've laid out all the problems and the issues I think that we've got to be aware of and deal with. I've concluded that at this point, I think we're going to manage our way through it in 2026. There will be sectors of the economy that I think are going to do very well. For example, commercial real estate is going to be a very active market all the way through 2026. Construction, commercial building is going to continue to be strong. That's extremely important here in Northwest Ohio. We're going to continue to see more companies interested in being in business in this area, primarily because of our location, intersection of major interstates, railroad, seaport, airport. We have what's required for transportation services. Problem is we've got to find truck drivers who speak English to make sure they're safe to drive our trucks, but I'm sorry, I made that political, didn't I? Probably politically insensitive, but the reality is we're located in a place that is ideal for this expansion. Now, we have to control it. Has anybody been by the intersection of 270 and 23 on the south side of Columbus lately? Okay. There is it's an Amazon data center. It's a Google data center. It is massive. I mean, I don't know how many square feet in these buildings, but it's huge. They probably had 5, 6, 7, 8,000 people, construction people building this building, this data center. When it's up and running, they'll have about 300 employees, most of whom are security personnel, because these data centers don't require a lot of workers. They have to be highly skilled engineering types that do it, but the building of that process involved a whole lot of workers. We're debating now about data centers here in Northwest Ohio. We have to be careful with that because the drain on our electric grid and water, which are the reasons they're interested in being up here, is a source of water primarily, can be huge. We already know electric rates have gone up as the drain on our grid system has increased. What will happen to water costs if we build a bunch of data centers? So there's a balance between growth opportunities and the nature of that growth. But I think we're in a great position here in Northwest Ohio to benefit over the next few years as more companies continue to bring production back to the U.S. as a result of tariffs. Tariffs can be good from that standpoint. The problem is the bad happens first. The good comes later. And it's hard to convince people the good's going to come with the negatives that happen initially, which is usually inflation, when you create these tariffs. So we have to be patient and allow that system to work its way through. If we are patient, then I think we're looking at several years of significant economic growth here in the U.S., some of which will be because of the tariffs, because that production here is here. That's the best I could do. I mean, I could stand up here and tell you this is going to happen, that's going to happen. The uncertainties are just so large and so pervasive that it's difficult to get much more than an indication. Once the government opens up and we start to get some data, we can see whether or not these uncertainties turn into real problems. As yet, we haven't seen it. Thank you.